Good day, traders. This is Roger Scott. For those of you who don't know me, I'm the senior trainer at Market Geeks. I'm going to show you another video presentation today. The last few weeks, I received tons of requests for more technical chart pattern strategies, so I decided to continue with another video for you today. Before we begin, I have to go through the required government disclaimer. So please read them carefully and make sure you only trade with risk capital. Trading futures and options carries a substantial risk of loss. So make sure you are comfortable with each strategy before you trade with real money. This video is for educational purposes only and is not a trading recommendation. Today's topic is going to be triangle breakout strategies. A triangle is a technical chart pattern. Typically, when analyzing market behavior using technical analysis or past price data, traders either rely on technical indicators or technical chart patterns. Some traders prefer technical indicators, and others prefer to use chart patterns in their analysis. Technical indicators are calculated using mathematics and statistical formulas and are completely objective. Some very popular indicators include moving average crossovers and oscillators such as RSI and MACD. The advantage of technical indicators is their objectivity. Because they are based on mathematics, they can be backtested and analyzed. Further, because indicators are based on mathematic calculations, they are difficult to misinterpret. Technical chart patterns, on the other hand, are simple visual patterns created by market price and, more or less, are repetitive time and time again. Since the early 20th century, many analysts and traders have been following classic chart patterns, and many professional traders rely on them extensively. There's a great book that's also on Market Geeks' recommendation book list titled Technical Analysis of Stock Trends by Edwards and McGee. This book was originally published over 60 years ago and still remains the Bible of technical chart patterns today. I highly recommend it to anyone who wants to learn the foundation of technical chart patterns and technical analysis in general. Getting back to our strategy, the biggest advantage to using chart patterns instead of technical indicators is less delay or lag, as it is typically called in the industry. Since indicators are mathematics or statistics based, their price leads and the indicator follows. The indicator cannot, I repeat, cannot calculate something that has not occurred yet. Therefore, the signal that the indicator produces and the trader acts upon is always occurring after the price has already moved. Therefore, there is always some type of a delay when using indicators. Since chart patterns are based on pure price, there is no delay or lag between the trading signal and the market price. One of the most basic type of chart patterns, and the one we will discuss today, is the triangle pattern, which is a continuation chart pattern. There are three different types of triangles: the symmetrical triangle, the ascending triangle, and the descending triangle. I will discuss each of them separately and then provide some examples for you. A symmetrical triangle, which is sometimes referred to as a coil, contains at least two lower highs and two higher lows. When these points are connected, the lines converge as they are extended and the symmetrical triangle pattern takes shape. The symmetrical triangle is considered a neutral pattern. This means it has an equal chance of breaking out to the upside as it does to the downside. The next type of triangle pattern is the ascending triangle. This pattern is similar to the symmetrical triangle, except the upper area, the resistance area, is flat instead of sloping downwards. The ascending triangle is a bullish pattern that typically forms during an uptrend as a continuation pattern. The bottom part of the formation is identical to the symmetrical triangle and must contain at least two higher lows. Finally, the last type of triangle formation is the descending triangle. This pattern is a bearish formation that typically forms during a downtrend. The formation is exactly the opposite of the ascending triangle. The upper area, the resistance area, is sloping down at an angle and must have two descending peaks, while the lower area, the support area, must have two lows of approximately equal distance. Now that you have seen the three different formations, let me show you how to enter the market using triangles. The first thing you want to do is make sure you enter the market in the proper direction. If this sounds obvious, you'd be surprised how many people get confused and try to enter a long trade when they see a descending triangle, and conversely enter a short trade when they see an ascending triangle developing. Please don't make such basic mistakes because they happen more often than you think. Another important note I'd like you to remember is make sure to take signals using symmetrical triangles in the direction that the market was trending before forming the triangle pattern. So if the market was trending up prior to the formation, only take breakout signals going long. And if the market was trending down prior to forming the triangle pattern, make sure you only take signals towards the downside. If you follow this rule, you will save yourself from many false breakouts. The last and equally important factor you need to know prior to entering either long or short on a breakout above or below a triangle is always make sure you wait till the market trades completely outside of the triangle for at least 1 day prior to entering the market. What I typically do is wait for the market to trade completely outside of the triangle and then wait for the next day to enter. If the outside day was above the triangle, I would put a buy stop a few ticks above the high of the outside day and see if the market hits that price the next day. I would leave the stop there for 2 or 3 days. If the market goes back inside the triangle, you should cancel the order. If you're trading to the short side, then make sure to wait for the market to trade completely outside of the bottom of the triangle, and then, only then, put a sell stop a few ticks below the low of that trading bar. Give the market a few days to hit the order. If the market goes back inside the triangle, you should definitely cancel the order. Once I enter the market to the long side, I place a protective sell stop a few ticks below the low of the outside day. Similarly, when I trade to the short side and my sell order is filled, I place a buy stop to protect my risk a few ticks above the high of the outside day. This way, if the market goes back inside the triangle, the trade will be liquidated. The next step is figuring out your profit target level. Fortunately, calculating the profit target is the same across 3 different types of triangles. You simply identify the highest point of the triangle and subtract the lowest point of the triangle. If you're trading long position, add the difference between the highest point and the lowest point to your entry price. And if you're trading to the downside, you subtract the difference between the high point and the low point from your entry price. In this example, you could see exactly how to determine the highest point and the lowest point for the ascending triangle. You would simply subtract the lowest point from the highest point and add it to your entry because it's an ascending triangle. Here's an example of locating the highest and the lowest point of the triangle in a descending triangle pattern. Once again, you simply subtract the lowest point from the highest point, but because it's a descending triangle, you subtract that amount from your entry cell. In this example, you can see how to identify the high and the low points for the symmetrical triangle pattern. I hope you enjoyed this tutorial, and if you want to see more short-term trading patterns, visit us at marketgeeks.com for daily trading levels and strategy updates. This is Roger Scott wishing you all a great day and lots of luck in your trading.